Now, on another topic, Canadian households are some $5 trillion wealthier than they were pre-pandemic. But research suggests that this excess cash is not necessarily going into the stock market. Instead, it might be used to pay off debt like mortgages. For more on this, we are joined by Royce Mendes, Managing Director and Head of Macro Strategy at Desjardins. As you see, he is here in studio. Hi, Royce. How are you?
Hi. Good. How are you?
I'm very well, thanks. So I understand you're doing some recalibrating in terms of this excess cash and what it looks like. Give us a hint here.
That's right. We had been hearing in 2024 from other analysts that there was this excess cash that, as interest rates on things like term deposits and GICs came down, would be deployed into the stock market, particularly in high dividend yielding stocks. But when we looked at it again in a bit more detail, we kept coming to the conclusion that it didn't look that excess once you normalized it for the larger size of the economy. I mean, to be quite honest, when we went into the research project, we thought we'd come to the same conclusion just with a little bit more data, that we'd say that there is excess cash and it will get redeployed somewhere else. But we kept finding that there wasn't that much excess. We also compared it to the total assets that households hold, whether that be non-financial, like in housing, or bonds, or equities. The cash didn't look excess, and so we concluded that we don't expect that there to be a big wave of money flowing into these dividend-yielding stocks in 2025, even if interest rates fall materially from current levels.
So this $5 trillion since the pandemic, is it primarily coming from the wealth effect of housing and stock market gains?
Yeah. So the net worth of households is materially higher than it was pre-COVID. But that's not because people are holding a whole lot more cash. To your point, this is because house prices are higher than they were pre-COVID, and stock prices are a lot higher than they were pre-COVID. So you can see that the net wealth effect has been increased from those asset classes. If anything, households in Canada are more highly exposed to equities than they typically are. They hold more equities as a total part of as a portion of their total portfolio than they typically do. So expecting that cash is going to all of a sudden migrate from GICs to equities, I think is a little bit wrong-headed. If anything, we could see in a world of heightened uncertainty and potential economic volatility in 2025 that this money either just moves into checking accounts as a buffer, which actually aren't that elevated in terms of their balances right now, or flows into safer fixed income products.
Now, do you do any analysis of, I'm sure you've heard the K-shaped economy example, so the lower portion of the cave where people are struggling with inflation and maybe they don't have as much income as others. Do you examine that part of the economy?
Unfortunately, in Canada, we're limited by the data we get. And one of the data limitations is that we only have very lagged numbers on the distributions of where this wealth is. So maybe to your point, we could assume that these are mostly higher income households holding this cash. So they don't need to necessarily redeploy it into savings just because into spending just because consumer prices went up. But what we could see, I think very likely, is that as the term deposit balances come down, people just leave it in their checking account. Now, that is a drag on portfolio, but that's not going to change. Households always act like this, and if anything, their checking account balances are lower than they typically would be for the size of the economy and the size of the population we have here in this country.
Now, Royce, in some of your past appearances, you've talked about all the mortgage resets coming to bear this year, and you did express concern, but rates have been coming down, as we know.
Yeah.
Are you a little less concerned now and how people will handle it?
I'm a little bit less concerned because I think the Bank of Canada is on the right track in cutting interest rates aggressively. Where maybe we come into this year and we re-up that concern is on the basis of what could happen, obviously, on the tariff threats. If we see 25% tariffs, our estimate is that the unemployment rate jumps to 8%. Higher unemployment rate is the greatest predictor of falling behind on your debt service payments, namely mortgage payments. The second thing that I would say is that the global rise in bond yield has dragged up Canadian bond yields, which affect mortgage rates. And so mortgage rates have not fallen as much as you would have otherwise expected, despite the fact the Bank of Canada has been cutting rates pretty aggressively. So we are cautiously optimistic that we'll get through this year without a big problem in the mortgage market, but that'll be contingent on the Bank of Canada continuing to cut rates and hopefully some reprieve on global bond yields.
Can you sort of wrap it up for us here in terms of your overall outlook and your team as well for 2025? Canadian households, they're doing all right. They've got some cash. Maybe they won't put in the market, but what's your overall view?
Generally speaking, I think Canadian households are going to be able to make it through this mortgage renewal wall, but it'll take something out of the economy. They'll have to reorient their finances, maybe pull spending from other places, because as I mentioned, the cash doesn't look that excess. The big risk is obviously on the tariff front, and that could change this analysis and potentially tip us into a recession if the unemployment rate moves up high enough.